Hello and welcome back to All Things Money. I'm your host, David Blain. We thank you for joining us today. We're talking about the peak of the market, which occurred 5 years ago today, October the 9th, 2007. It's a time to reflect on how you reacted to the market meltdown in 2008. We also had 2009, early 2009 was very bad. And then, of course, in 2010, in the summer, there was a small decline of about 15%. And then last October of 2010, of course, was the debt crisis and the downgrade of the U.S. debt. So it's been a very volatile 5 years. And how you've reacted, how you've positioned your portfolio through that time is very important that you step back and reflect on it. If you sort of had a tendency to panic and sell out at the wrong time, well, that means you probably were taking too much risk in your portfolio. If you didn't look at it every day and were just kind of rebalancing, that's acceptable. The people that had extra money and were actually buying in at some of these low points have done extremely, extremely well. One of the big takeaways, I think, of this is that you hear that diversification failed. That is not true, and we don't want people to give up on diversification. High quality Treasury bonds and corporate bonds did very well through these times of panic. We also see real estate has been a tremendous gaining asset class. When I tell people that, they look at me like, are you kidding me? But it's true, especially in the REIT, real estate investment trusts have done fabulously well the past 3 years. Now, they also declined a lot more than the market in 2008, 2009, but coming off the 2009 lows, it's been a wonderful place to make money. Gold has continued to do very well, and of course the U.S. stock market since 2009 has done very, very well. We're seeing a lot of problems still in Europe, which if you look back at the past few years, I would be looking at Europe at some point is going to recover. Some of the companies over there are excellent companies that you want to look for places that have been beaten down in value. We like to look for things that are bargains, but that are starting to turn the corner. There's a saying on Wall Street, don't try to catch a falling knife. So we prefer, not to be too early, but at some point Europe is going to turn around. And there's going to be some tremendous bargains over there. So we just encourage you to look at the past 5 years and how your portfolio did and how you reacted to that. As most people know, we are in the business of managing people's investments, and if you don't feel like you did very well the past 5 years or don't want to deal with it in the future, well, give us a call and we may be able to help you, at least help sort out what type of portfolio may be right for you based on your reactions. So kind of continuing that theme, let's take a look at the first 9 months of the year. We just finished the third quarter of the year. And once again, it's been a very eventful year so far. We saw that in the first quarter, saw the strongest U.S. stock market since 1998. The markets gained about 13% in the first quarter. And the global returns were very similar to that. In the second quarter, emerging markets in Europe had most of their problems, losing 9% and 7% respectively. We saw the problems happening in the European Monetary Union. We saw the growth in China and India scaling back, and so we saw emerging markets really start to scale back a little bit. Now, in the third quarter, that reversed somewhat. The U.S. market up about 6%, Europe up 9%, emerging markets up about 8%. And this goes back to what I was talking about in the first segment, is that diversification still exists. It's still beneficial to have your assets both geographically diversified as well as asset classes. It also helps if you're regularly saving. I realize a lot of you out there are spending your portfolios down, but I want to talk for a minute about people that are actually investing and saving. One of the things that you hear a lot about is what's called dollar cost averaging, and what that means is if you have a diversified portfolio that every month say you're saving, $100, $500, $5,000, whatever it may be, and you're always putting that money in, what happens is at the peak of markets, your $5,000 is buying less shares. So you're buying less at the peaks, and when the market is down significantly, you're able to buy more shares. So essentially, you're buying low and you're selling high to some extent. If you're rebalancing, let's say you have equal 50-50 stock and bond. If the stock market goes up a lot, your new money coming in is going to go into the bond market to bring your mix back to 50-50. So you're in effect buying low and selling high. Now there's been numerous studies on both the dollar cost averaging effect as well as the rebalancing effect. And depending on which study you look at, this can add somewhere between a 0.5% up to 2 percentage points of return per year over the long haul. So once again, rebalancing, selling high, buying low, and continually adding money on a regular basis has been shown to add between 0.5% and 1.5% of returns, depending on what the market is doing. It especially works very well in volatile markets where you have these ups and downs, and by having some sort of program, you can take advantage of that. In the next segment, I'm going to continue talking about what's going on in the markets and some things, but I also want to introduce a concept called value averaging, which is not, instead of dollar cost averaging, is an even better way to sort of turbo boost your returns. Now you have to have a little bit more money to do so, but we'll talk about that after a few short messages.